Hi, everyone. My name is Paul Gu. I'm one of the co-founders and head of product at Upstart. Great. I'll give you a very quick background on Upstart for context. We are an online consumer lending marketplace. We came into existence about 3 years ago with a focus of lending to generally younger borrowers with shorter credit histories. So in some sense, the whole reason we exist is we thought we could do a better job of underwriting a segment of the population that traditional credit scoring models could not evaluate very well. So today I am here to talk about the concept of finding risk-free in consumer lending. And I'm going to be talking about this sort of as a concept, as a sort of preamble. I will say you should not expect at the end of this talk to know how to find risk-free borrowers, because I have no idea how to find risk-free borrowers. But I do think it's an important conversation for us as an industry to be having. The first place I want to start is by talking about what I'll call first principles. And what I mean by this is the fundamentals of an activity or business that is removed from the specifics of how it's been done traditionally in the industry. Elon Musk actually said that when he was founding SpaceX or Tesla, he would think about the underlying sort of physics of what was in electric cars or what was in space travel, and not think about the analogies of what already existed in the industry or how things had traditionally been done. And it's only by thinking in this sort of foundational way that you can really make large leaps of innovation. And I think in our industry, and I'm certainly guilty of this as well, we tend to think a lot by analogy and not very much by first principles. So if we were to think in terms of first principles, what would we think about in lending? Well, the first thing you would have to think about is what happens when you lend someone money. And this graph is actually backwards. It should say the probability of not paying you back. So just imagine that we're there. But you basically, if you were to give someone money in an ex post sense, there can really only be two outcomes. Either they pay you back or they don't pay you back. And in most lines of lending, most people will pay you back. So that's what this bar at 0% is. The probability of them not paying you back ex post is 0%. And for these other people, for the most part, the probability ex post that they will pay you back or will not pay you back is 100%. There's basically binary outcomes in lending. And for the people who 100% will not pay you back, you should never lend to them at any interest rate. And for these other people, these 0% probability of defaulting people, you should be willing to lend to them at a very low interest rate, specifically where your R is equal to the time value of money. So if you were to give someone a 1-year loan, you should be willing to lend to them at a rate where 1 year later you just get that money back plus whatever that 1-year delay was worth to you. Generally, we tend to think of this as the risk-free rate. It's some very, very low interest rate. And the reason we, in this hypothetical world where everybody is in this sort of binary distribution, we would be able to charge such a low rate is that we never lended to anybody who did not pay us back. Everybody had a 0% chance of defaulting. Now, reality unfortunately does not look like that. So this is a distribution of FICO scores at least as of 2013. And on this side, you have people with over 800s. That side, you have people with under 500s. Sort of approximately represents how we as an industry think about the distribution of risk across the population. And you can see that it does not look like a binary distribution. Most people actually are somewhere in the middle. There are a few people, these 800 pluses that you could think of as not quite risk-free, but almost there. And then these people below 500 who most lenders will not consider lending to. But most people are in the middle. They're in the 600s, 700s. These score ranges that basically mean they have some probability of defaulting, but we're not really sure if they're going to default or not. And so we're going to charge them a decidedly non-risk-free interest rate. And then hope that on average things work out for us. And this is clearly very different than what we would ideally like to have happen under sort of the first principles type of thinking. So a result of this is that we get interest rates that look like this in the real world. We have R equals the time value of money plus compensation for the loans that will not pay you back. And then an extra compensation for volatility, because some loans will not pay you back. You now have to not only charge the people who will pay you back more money to compensate for those people, but you have to charge them even more to compensate for the fact that you don't know which people are going to pay you back. Any given portfolio has a chance of losing you money, and so now you demand compensation for the volatility, and so now you've sort of got a double whammy of higher rates that get passed along to the borrower, which is unfortunate. And so what it really means is that the world we have today is a world where people pay non-risk-free interest rates. And if you are paying a non-risk-free interest rate, that necessarily means that you're paying for other people's defaults. As a borrower, what you're really doing is, if you're paying, that means you're in the binary part of the distribution where you are paying back. You haven't done anything wrong in repayment of your loan, and yet you'll be paying an interest rate that reflects the risk of you not paying back, which is actually the risk that somebody else did not pay back, but you're going to be paying for them. And that really sucks. So, one important question that immediately arises in thinking about this topic is it even possible or worth thinking about the concept of how you could eliminate this unfortunate component of risk from lending? And a natural place to sort of look for inspiration would be in insurance, because both insurance and lending have some similar characteristics. They both use this process of underwriting to assess risk, and then you try to price appropriately. And one thing that you may notice is that there are many, many different insurance markets. I just went on Wikipedia, and there were some hundreds of them, including ones I'd never heard of, like alien abduction insurance is actually a real product that exists that you can pay for. And even alien abduction insurance is not priced at the risk-free rate. It's considered a non-zero risk, as well as pretty much every other type of insurance product. And so it sort of begs the question, is it maybe impossible for there to be things in consumer lending that could be underwritten at a near risk-free rate or risk-free rate? Is it really just like insurance? And the good news is that there's actually one big difference between lending and insurance that makes it so that while in insurance it is almost theoretically impossible to have risk-free, in lending that is not the case. And that's because in insurance, risk is the reason insurance is useful in the first place, but that is not true in lending. So a truly free insurance product that were priced properly by the insurer would actually be completely useless to the insured, because there would be no underlying risk, and then you would not want insurance in the first place. But a truly free loan would just be awesome. Everybody would want a truly free loan. And that means that there should never be any examples of insurance markets where there's no risk that is being priced in, because then that product would simply be eliminated from the market. And there could still be loans that have no risk. And in fact, there are some examples of markets where there's sort of risk-free loans being issued. One of them is in very, very short-term government bonds. So treasuries just a couple weeks ago were pretty much at zero for 1 month government treasuries, which basically means that lenders were saying the US government is pretty much never going to default, at least in a 1 month time frame, and I'm willing to give money to the government at zero, or in some cases in Europe less than zero. And so clearly it's sort of theoretically possible for there to be risk-free loans that are given out. And then you might naturally ask, well, how useful of an analogy really is this? Because now we're talking about the US government, which is really, really big. It has a lot of money. It can raise taxes on you all if it needs to. And there's not a very high chance the government is going to be unable to pay back these loans. And so in that sense, it's unfortunately not a very useful analogy for most consumers, because the vast majority of borrowers do not look anything like the government. There are some small slices of the population that have similar characteristics of being what I'd call sort of obviously creditworthy. So if you look at some of the loans given to super prime borrowers, for example, in student lending or in mortgages, there are rates that come very close to near zero, because those borrowers, you just look at them, you don't really have to do any underwriting. You just say, wow, they're really, really prime. They have great income, low debt, like long history of credit, everything looks perfect, so this person is almost certainly not going to default on you. But again, most people don't look like that, so that's not going to be tremendously helpful for us in thinking about this problem. But there is one other field that we can look to for inspiration, and that field is physics. And the reason I say physics is a useful field is that if you were to ask the question, where can you find models that have almost no unexplained variance, you would look to physics. And one example that we're all very familiar with is gravity. So if you were to say, let's build a model to predict how long it will take this apple to fall from the tree, we can actually predict that with almost perfect accuracy. Not quite perfect if we don't understand the wind resistance and things like that, but it will still be extremely, extremely close. And it's defined by this formula here. You basically plug in the distance and you get out a number. So if you have like a normal tree of 5 meters or so, then you get, it takes about a second for the apple to fall from that tree and hit the ground. And this model will explain pretty much 99+% of all the variance that goes on here. And the reason that physics is able to do such a good job in predicting outcomes like the apple falling to the ground, or in things like how long or when the sunset will be or when the sunrise will be, is that it's not actually a statistical model in the way that a lot of lending models are, including ours, by the way. It's actually a cause and effect sort of based model that describes how the physical world works, as opposed to a model that just happens to find a bunch of variables correlated with what actually happens. It sort of has found the equations that actually describe how real things work, as opposed to equations that happen to correlate with how real things work. So what is sort of an analogy in lending? Well, one analogy that we all sort of use to an extent is this kind of very abstract wealth equation, which is something like you start out as a borrower with some savings. On a recurring basis, you add to it some income, you subtract out some debt obligations that you have, you subtract out your expenses, and you're left with a certain amount of cash to service a loan. And as lenders or investors, we all obviously look at something like this, and this in some sense is at a fundamental level the high level physics of what is going on in lending. But this unfortunately is not tremendously helpful because it's so high level that within any one square there's sort of a whole world of relationships that still needs to be explored and discovered, and does not really help us understand what's going on. So for today, we're just going to zoom into one of these, and let's talk about income, and I'll talk about some of the things that we're doing at Upstart to try to better understand what is happening sort of in a cause and effect kind of way, as opposed to just a correlation kind of way. So this is a very simple example of some of the things that we will look at in thinking about something like income and how things work in the real world. So we might take a person who might say, we know this person majored in mathematics. We know that majoring in mathematics seems to cause you to be able to get certain types of jobs that you could not get if you were not a major in mathematics. You could say the same thing about earning a certain GPA, which causes you to be able to get certain types of job interviews and maybe get certain types of jobs. The same could be true of work experience or the field that you work in. And so these are all sorts of variables that aren't just correlated by happenstance with outcomes in credit, but they actually, we believe, cause outcomes in credit because they cause someone to be more employable, they cause them to have certain income levels that in turn make them better able to fulfill this general equation in a way that leads to them not defaulting. So in this specific example, we have a portion of our model that is really dedicated to building out a kind of, you can think of it as a giant kind of simulation where there are lots of inputs, things like what someone studied in school, that drive then cause and effect behavior in the model that produces things like, okay, we believe that this person's unemployment risk is such and such, that if they are employed, their income will be such and such. And these relationship type models we're building are different from standard correlation-based models because they don't just say, oh, this person had a lot of inquiries. In the past, people with a lot of inquiries also happen to default a lot. This model actually says, this person majored in math. We think math majors get employed a lot. We think employment leads to income, and income leads to paying back your loans. So as sort of a general as a general point, aside from the specific variables that we at Upstart use, I think as an industry, something we don't think enough about is this sort of general idea of how we build models that are sort of grounded in cause and effect in the real world, as opposed to models that just happen to be correlated with how things are working in the real world. And if we want to build models that can get us closer to risk-free and get us closer to the sorts of models that we'll see in physics, as opposed to the sorts of models that we'd see in insurance, then what we actually have to find are new variables that actually describe how things work, as opposed to just happening to be correlated with how things work. So that's all for my slides. I'm happy to take any questions that people have, or dive deeper into any of these areas to the extent that I can.